So hi guys, welcome back to the Fourth Revolution. Today we're talking about this market cool down, what's causing it, and how much further we can go. So I'm going to check out a couple levels that I'm looking at and a couple stocks that I'm looking to buy on a further downside. So this is the chart of the S&P 500. You can see we've had a huge, almost undisrupted rally from May 14th all the way up to early June 8th. And we had a little bit of a pullback. I mean, I think we were hanging by a thread up here, very frothy levels. All it took was Jerome Powell's bleak outlook on the economy and telling us to check our risk reward in the equity market, so to speak. And we saw a bit of a downfall, which we were supported here at the 3,000 level with the battle between the bulls and the bears, and the bulls won out here, but I don't know if it's going to happen again. We came back down today to this 200-day moving average, which is right around 3,000, 3,020, and we bounced off of that. So people are concerned right now with the uptick in cases around the U.S. A lot of this has to do with the protests we've seen attributing to more and more of these cases coming out. So people are a little bit concerned, especially at the levels that we're at today. So I think we could be in for a further pullback if the bears can win out here. So levels I'm looking at are this 200-day moving average. If we can pass that and this 3,000 level, which I've drawn up here. This is a 50% retracement from our May 14th lows to our June 8th highs. And this is a level that is going to be crucial for a further pullback. And right now, I'm hoping for a pullback. I'm not looking to chase this rally. I'm not looking to buy anything right now. So I'm hoping for a pullback. I'm hoping we can get back down, honestly, get back down to this 2,800 level. That's when I'm going to be a big buyer of equities. So some people may start buying right around this 2,950 level, which is between the 50-day moving average, which is here in blue, and this level right here, Fibonacci retracement of 2935, which represents the 61.8 golden ratio. I'm not sure if you're familiar with Fibonacci retracement levels, but this is the level that is most important for this retracement. So look out for that. If we can break through this, I have no question that we're going to come back down to this 2,800 level. And this is where I think we should be heavily buying the broader equity market. So looking at the Nasdaq 100, I know I've discussed this before, but we are breaking out in this index here. And the reasons being is because we've had a huge tailwind, like I've discussed before, because of this stay-at-home order, and the world is becoming more and more digitally inclined, and this pandemic has only expedited that process. So as the digitalization continues, and Jerome Powell and his dovish band of Federal Reserve governors continue to keep rates low, and they're saying they're going to be low through 2022. This actually makes these tech companies more valuable today than when they were before the pandemic, because of the fact that analysts discount all these companies' future cash flows, which are significant for growth companies in the Nasdaq 100 because of their growth-oriented tech companies. So they're significant in the future. So they discount those back based off of future interest rates, and future interest rates are low. So the value of these companies is higher. So I think this is justified right here at these all-time highs. And I am looking for a pullback because I still want to buy these tech stocks. And a couple of tech stocks that I'm looking at are SE, and this has just had a relentless run from its lows in March, and you can see it came from right around $35 to $115 per share in just a matter of 3 months, which is unbelievable. But this company is unbelievable. It's shown year-over-year growth that is in the triple digit percentages for the last 8 quarters or so. So we're seeing a little bit of a pullback. I'm looking to buy. I would love to see it fall back down to this 50-day moving average here, right around 75. I'm not sure if that's going to happen. I think any price, around 80 to 90 would be a good buy for this stock in the long term. Because this company is breaking out. It's the biggest digital company in Southeast Asia, and this economy in Southeast Asia is digitalizing very, very, very quickly. And C is controlling that market and able to capitalize on it. You can see it with this stock, and investors finally starting to realize the potential that this stock has. So Twilio is another stock that I really like. This stock is controlling the AI customer service segment, and it's a cloud company that is kind of disrupting the entire contact center this contact center market. So it's bringing contact centers from overseas back home, and this is what companies want to do right now. They want to cut costs and reduce their international exposure, and Twilio is helping them do that. Twilio works with companies like Uber, Lyft, and Airbnb, and like companies that rely on customer service for their success of the company. So you can see this company's kind of been trading in a range between 70 and right around 150 for the last year or so, but it finally broke out during this quarantine on earnings on May 7th here, and you could see it just exploded off of those earnings after it showed huge beats and a guidance that was very optimistic. So once again, it's another company that investors are finally starting to realize is going to be huge in the future and be a great driver for this fourth digital revolution. And I think this is a stock to look at. I'm not liking it at the 215 level we're seeing today, but I would love to see it fall back down right around to 170. This is where I'll be looking to buy. That's the 50-day moving average here. If we could go even further down, I'll continue buying. I'll continue buying until we get down to 100. I mean, this company is a powerhouse and will be a powerhouse in the future. So last but not least, Alibaba. And this has been my pick for the entire quarantine COVID trade. And I love this company because it not only outpaces Amazon in every metric you can imagine, including margins, profitability, and long-term growth, but this company is valued at half the market cap of Amazon, and it hasn't really broken out during this quarantine season. So I'm looking to buy this. Honestly, I think it's a buy right now. But if you're going to be a little bit conservative with your investments here, I may wait till it falls back down to this 50-day moving average here, right around 210. I already own a good amount of Alibaba, so I'm waiting to see it. If we could get back to this 50% retracement right around 200, I will be a big buyer then, and I'll add to my position. So I know a lot of people are wanting to buy this pullback, but I wouldn't be overzealous right now. We're still quite frothy. I know I keep saying that word frothy, but we're at levels that I think are unsustainable considering our economic condition. And I would wait for a further pullback to really put my money into the markets. And the three stocks that I discussed are going to be companies that will drive your portfolio in this fourth revolution and over the next decade. They're going to be huge drivers, and being a part of these huge investments are going to be something that you do not regret. So take a look at those and take a look at the levels that I discussed. So don't forget to like, subscribe, comment, and check out our latest promo at Zacks.com. It is a free book by our VP, Kevin Matris, and it's called Finding Number One Stock. So check that out at Zacks.com/promo.